Assalamualaikum and greeting to our lecturer Dr. Nurhani and my fellow friend. So in this video, our group would like to present our topic group assignment for ECO531, which is Bank Negara Malaysia lower SRR from 3% to 2% in move to release RM30 billion into the banking system. Before we start our presentation, I would like to introduce my group member who also will present for this group assignment. Firstly is Ryan Abilian, second is Muhammad Shazwan, and third is Nazirul Zono, and lastly is myself, Muhammad Bazil bin Muhammad Azam. Firstly, I would like to talk about my part in this group presentation, which is abstract, introduction, and background of the article. So let's begin, shall we? Firstly, abstract of the article. The article topic is about Bank Negara Malaysia lower SRR ratio from 3% to 2% in move to release RM30 billion into the banking system. It is reported by the Edge Market on 19 March 2020. The author is Ahmad Nakib Idris. Stated on what had been announced by Bank Negara Malaysia, where 100 basis point cut in the statutory reserve requirement ratio from 3% to 2%. Besides that, it also stated each principal dealer might able to recognize Malaysia government security and Malaysian government investment issue, or known as MGS and MGII, of up to 1 billion as part of SRR compliance. By lowering the ratio, it gives benefit to the bank by letting the bank to create additional return while stimulating lending activity in the country. Introduction of the article. Bank Negara Malaysia lower SRR ratio from 3% to 2% in move to release RM30 billion into banking system. By decision to decrease in the statutory reserve requirement in order to undertaken to maintain the sufficient liquidity in domestic financial system. Also continue to support the domestic financial markets to become more efficient and to help effectively improve liquidity management by the banking institution. By lowering the statutory reserve requirement, it will bring out several benefits by releasing this liquidity into the banking system. As for the bank researcher said, it could assist in improving net interest margin once the additional funds are invested. Besides that, the fund also could help in shoring up liquidity ratio that have been declined for over the past 3 months. This is due to customer shortening tenure of the fixed deposit. Article background. In the statement of the news edgemarket.com, Ahmad Nakib Idris spoke about Bank Negara Malaysia lower statutory reserve requirement ratio by 100 basis points from 3% to 2%. It moved to release RM30 billion into the banking system. Not just that, it also stated the flexibility is available until 31 March 2021. Furthermore, this combined of measure will release around RM30 billion worth of liquidity into banking system. It also explained the function of statutory reserve requirement, where it is an instrument that used to manage liquidity. Banking institutions are required to maintain balance in the statutory reserve requirement account that must be equal to a certain portion of their eligible liability. Besides that, it also stated the function of overnight policy rate, or PR, where it's a sole indicator used to signal the stance of monetary policy. Lastly, it also stated that it is the second statutory reserve requirement cut in a 4 month, where November 2019 last year, the statutory reserve requirement is 3% was announced. The ratio was lowest in the 2016 from 4% to 3.5% has also been stated in the news.
Hello everyone, my name is Muhammad Shazwan bin Yusuf and now I will present my part, which is the issue and the discussion. So let's go through the slide. So the issue has given is Bank Negara Malaysia lowers SRR ratio from 3% to 2%. It moved to release 30 billion ringgit into banking system. Okay, the question is, why this issue happened? So, the issue happened because of the country has faced recession and unemployment during this pandemic COVID-19. Because of recession and unemployment, Bank Negara Malaysia has to need to find the solution to recover back the economy. So, in this article, Bank Negara Malaysia has decided to reduce the statutory requirement, which is SRR, from 3% to 2%. Besides that, liquidity crisis also happened during recession on this pandemic. A liquidity crisis can unfold in response to a specific economic shock. During this time, government has announced Movement Control Order, which is MCO. This has affected a lot of parties such as the business company, restaurant, services, and many more. They need to stop the operation and also the workers are forced to stay at home. The effect from this action is the economy cannot run well and people cannot get the income. They need to use their saving for expenses. So that's why BNM decide to reduce the statutory reserve requirement from 3% to 2%. 30 billion ringgit was released out to commercial bank, so bank can affordable to give loan and generate back the income from the loan. Next, as we can see in the issue, the statutory reserve requirement, which is SRR, is one of quantitative measure under monetary policy. The definition of the statutory reserve requirement is an instrument to manage liquidity. Banking institutions are required to maintain balance in their statutory reserve account, which is SRA, equivalent to a certain proportion of the eligible liabilities, which is EL. This proportion being the SRR rate. The SRR is used to inject liquidity when the excess or lack of liquidity in the banking system is perceived by the bank to be large and long-term in nature. In this case, Bank Negara Malaysia lowers the statutory reserve requirement so that the commercial bank are required to hold less cash on hand and commercial bank is affordable to make more loans.
Hello everyone. Today I'm going to explain on my part, which is the solution on this issue. So there are five solutions, which is legal reserve requirement, discount rates, open market operation, interest rates, and selective credit controls. Now let's look into the slides. Now, the first solution is for the bank to reduce statutory reserve requirement more to 1%, which is using the quantitative measure, legal reserve requirement. The reserve requirement is a central bank regulation that sets the minimum amount of reserve that must be held by a commercial bank. The minimum reserve is generally determined by the central bank to be no less than a specified percentage of the amount of deposit liabilities the commercial bank owns to its customer. Now, in 2009, the lowest ratio is at 1% on March 9, 2009, which was during the global financial crisis. So as you can see in the graph, which is March 9 until March 11, 1.0 of SRR has been recorded in that year, the lowest. Now, if the Bank Negara Malaysia decides to lower the reserve ratio through an expansionary monetary policy, Commercial banks are required to keep less cash on hand and are able to increase the number of loans to give consumer and businesses. This increases the money supply, economic growth, and the rate of inflation. Next, discount rates. For banks and depositors, the discount rate is the interest rate assessed on short-term loans acquired from regional central banks. Financing received through the central bank, lending is most commonly used to shore up short-term liquidity needs for the borrowing financial institution. As such, loans are extended for only for an overnight term. When BNM makes a change to the discount rate, economy activity either increase or decrease depending on the intended outcome of the change. When the nation's economy is stagnant or low, this is where BNM may enact its power to reduce the discount rate in an effort to make borrowing more affordable for member banks. When banks can borrow funds from the BNM at a less expensive rate, they are able to pass the saving to banking customer through lower interest rate charged on personal, auto, or mortgage loans. This creates an economic environment that encourages consumer borrowing and ultimately leads to an increase in consumer spending while rates are low. My third solution is open market operation for this issue. Open market operation refers to a central bank's buying or selling short-term treasuries in an open market in order to influence the money supply, thus influencing short-term interest rate. Open market operation allow the central bank to buy or sell treasury in such large quantity that it has an impact on the supply of money distributed in the bank and other financial institutions around the country. By using this system of open market purchasing, BNM can produce the target central bank funds rate it has set by providing or else taking liquidity to commercial bank by buying or selling government bonds with them. The objective of OMOs is to manipulate the short-term interest rate and the supply of base money in an economy. Thank you.
Okay, thank you Ryan for your explanation, and now I'm Nazirul Zunu. I'm going to explain for the next solution. Solution is the interest rate, whereby BNM influence the interest rate by lowering the interest rate, which is the best lending rate. Influencing interest rate is one of the most important things central banks do, because interest rates have a profound effect on economic growth, job creation, and inflation. Next, with the lower base rate from banks, it allows business to borrow money cheaply, which then enables them to expand and hire more people. Meanwhile, for consumers, low rates enable people to borrow money to buy homes and big ticket items such as automobiles, furniture, appliances, vacations, and other items that boost economic growth. Conversely, with the high interest rates have the opposite effect, where discouraging business and consumers from buying and investing. But sometimes, central banks need to raise rates in order to keep the economy from overheating, which could lead to inflation. That could eventually push prices higher and make goods and services too expensive, which could then cause the business and consumers to stop or curtail their spending, leading to slower economic growth and eventually a recession. On my next solution, where it can be used with the selective credit control, where it means credit control is adjustment that made by central bank of volume credit to suit the needs of the various sector of the economy for productive purpose only. Bank Negara Malaysia can use this to regulate consumer credit, which is installment sales, by manipulating the size of down payment and the number of installment. For the third one, BNM also can manipulate import pre-deposit requirement to regulate imports. This Bank Negara Malaysia could also determine ceilings and total credits for individuals from commercial banks. And lastly, this control is to ensure price stability and economic growth of the country. In conclusion, it is important that Bank Negara Malaysia as central banks to help commercial banks to get more room to lend money to industries or to the various sector because it will bring the liquidity into financial market. So once it brings liquidity inside the market, there is momentum that bank generate. And as for consumer, there is more room for them to spend the money. It is all about the consumption contribute and it's significant to the overall gross domestic products equation. This is strategic decision by our central banks, which is Bank Negara Malaysia, to maintain the growth stability, to maintain the price inflation stability, and to maintain financial stability. Actually, it is a good move by Bank Negara Malaysia because they are taking the micro level outlook that will provide boost and therefore support gross domestic product at the micro level. And thank you.